The views and opinions expressed in the following paid program are those of the host, callers, and guests, and do not necessarily reflect the views or positions of this station, its management, or owners.
Securities offered through Kestra Investment Services, LLC. Kestra IS, member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services, LLC. Kestra AS, an affiliate of Kestra IS. Capital Advisory Group, Inc. is not affiliated with Kestra IS or Kestra AS. Neither Kestra IS nor Kestra AS provide legal or tax advice and are not certified public accounting firms.
You work hard for your money. For the next hour, you're going to learn how to keep what's yours. Capital Advisory Group presents Keep What's Yours. Here are Josh Gilbert and Jeff Zufall.
Hello and welcome to Keep What's Yours with Jeff Zufall. My name is Josh Gilbert, sitting here with Jeff Zufall, Senior Tax Strategist and Wealth Advisor with Capital Advisory Group. Hello, Jeff.
Hello.
Welcome back to the show. Welcome back this weekend. Some more interesting stuff that we want to talk about today. This is brand new information as well. Secure Act 2.0 got passed in February of 21.
21, yes.
But it took till 23, 24, and 25.
Yes, it has 4 or 5 different components that get put in each year as we go forward. So we have some fun ones for 24.
So there's new things. And are these things that we will bring to you? So full disclosure, Jeff is my tax guy. He's my wealth advisor. He's my guy. And that's the best is when you have a tax strategist. Your tax guy is also your wealth advisor.
Yes.
Because it's one-stop shopping.
Yes. Makes it 10 times easier. And again, there's great reps out there, but they will say, oh, consult your tax advisor. And then you have to take all that data over and go talk to your tax guy, and your tax guy goes, what are you doing? And then you get in this conflict back and forth, and the left hand doesn't know what the right hand's doing.
The tax guy's an idiot.
Yeah,
your wealth advisor's an idiot, and
Yeah.
and you just say, well, Jeff, I want to talk taxes. And he says, okay, let me go get your tax advisor. And then he spins his chair around.
That's
and
right.
Says, hello.
Real quick. Hi, that's me. I got to when I'm a tax guy, I got to put my pocket protector in. And then go,
hello, let me get my abacus out. So it's just really helpful to have your wealth advisor also be your tax guy because you can talk to us about every move that we make, regardless of with its retirement or with while we're accumulating our 401k, our Roth, everything has a tax implication.
Yes. Everything that you do in the financial world will end up on your tax return at some point in time.
I think everything we do, period.
Pretty much it's getting that way that, they're going, hey, we're going to tax you for that.
Yeah. And I love when they do this. They're like, well, this has won't affect your taxes at all, but we still want you to tell us about it.
Tell us all about it.
Yeah, geez. So I don't owe more taxes. No. Then why do I have to tell you? Because.
Just because. It's coming down the pike in 4 or 5 years.
So it's one of those things where you need to have a tax guy, have all the knowledge of what you're doing on both sides, and that's kind of what Jeff does. So might as well have one guy take care of it.
We talk to people all day long that are like, oh, I owe tax. If you're still working, the concept is first thing we look at is, do you do a 401k? Do you do an HSA? Those are quick, simple, easy ones, and you instead of paying the IRS, pay yourself first and offset that tax. Super simple.
Super simple. So everything that you do has the tax implication, and what you may not realize, because I don't know the tax code, I'm going to talk to the listeners right now. You don't know the tax code either. So everything that we do could have some tax beneficial ways of doing it. You know, it's like we're not going to stop you from buying the boat. Yeah. But we can
explain to you, hey, maybe that boat, you could take it as a second home because it has a kitchen and a bathroom in it,
Who knew?
Yeah.
Who knew
you
that
get
you
to write
could do
off
that?
the interest.
So
buy a bigger boat. No.
Yeah, right, exactly. If you splurge for the one with the kitchen, you can write it off. So all of these things affect us every single day, and you got to find somebody that can help walk you through it. Not only to tell you about it, which is what we do with the show every week,
but to guide you and walk you through it.
To help you implement it into your plan. So we're going to talk about the Secure Act 2.0 as we get into the program here. But first, I have some of my own tax questions, and it affects everyone, not just me. But tax season is upon us.
Oh, it is.
How are we looking? Anything come up? Have you started doing returns yet?
Oh, we've done tons of returns already, and tons in the works. We're waiting. Typically, what we're waiting for is right now we're waiting for 1099s, 1099 DIVs, which are your brokerage statements in a sense. Some are out. Some we don't trust. It's too early. Others they're out, and it says preliminary. So if you have a 1099 that just showed up in the mail last couple of days, look in the upper right-hand corner and see if it says preliminary.
What would it say otherwise?
Say final and give you a date. And if it says final and a date, go for it. But what we're seeing is a lot of people, whether they realize it or not, with the good effect of the Fed raising interest rates over the last 2.5 years, is now for fixed income you can make money. I mean, literally, 2009, I think, was the last time that anybody really saw interest rates that, were worth anything. But what we're seeing now is people who had CDs, who had just cash in the bank, they're quadruple what they were 2 years ago. So you made more money, but guess what? It's now forcing taxation.
Right.
Kind of that I won't say overlooked, but overshadowed, whatever you want to call it. All of a sudden, the 1099s are coming in. You're like, wow, I made $5,000 in interest, and I had $200 the last couple of years.
So let me ask you this. It is a progressive tax code.
Yes.
And the more you make, the more they tax you. But if I only make my first $10,000,
technically don't pay any tax.
Don't pay anything. Yeah. But then the first 30, then they start taxing me at one rate.
Yeah.
And then once I get to 50, everything, after 80 or everything after everything after that gets taxed.
Yes.
So let's settle an urban legend, an old wives' tale. I've had people tell me, I got a raise, but it bumped me up in a new tax bracket. So technically I'm making less than I used to.
No,
that is not the case.
I say that. There's always an exception to the rule. We're dealing with the IRS. If you're about $416,000 or greater, yes. So, if you got the raise of a lifetime, you got a $200,000 raise, it could throw you into a very weird tax bracket that, I would say that could be an issue. But mainstream America, no. Even if you stepped over now the funny part is I guess it really goes from the 12 to the 22% tax bracket. That's a 10% increase, but it's only 10% on dollars above that threshold. So again, if you're $5,000 ahead of that threshold, yes, you're going to pay 10% more on
only
that
on that $5,000, though.
Exactly, but it's only on that extra earnings. So no, it's not like you're making less by no means.
So when these people are on fixed incomes and maybe they have got their money in a money market, and with the interest rates being what they are, they're starting to they're earning money, but they owe more taxes.
Yes.
But they made more money.
They did. But the flip of that then, too, is you got to take it into the big scope, which is inflation is still out there. So they made more money, but they're going to end up spending it.
Yeah.
So you go, it's kind of that double-edged sword where, interest rates are higher. Now there is this, I don't know what you want to call it, the Fed kind of, I won't say played their hand last year, but they kind of came out and said, hey, we might lower interest rates next year. Everybody went berserk saying, oh, that's pure politics, da-da-da. I think what they were doing, though, was they were preempting it to say, hey, in 24, if we really did lower interest rates or really do lower interest rates, that it wouldn't come out like they were playing politics. With some of the data that's come out in the last couple of weeks, it looks like they're going to push it back a little bit.
Yeah, what happened this past week?
So CPI numbers came out. Inflation is starting to rise back again. That's the fear of the Fed as they've raised rates to where they are today. And then they have actually sat since, I'll call it first quarter of 23, they haven't done anything.
Stand pat.
They haven't passed.
Over a year.
They've just sat where we're at. And they're saying that, again, the Fed always says we're data dependent, depends upon numbers that come in on a regular basis. And then they plopped this thing out last year saying, hey, we might lower rates next year. I think they were preempting it just in case they did. It didn't look like that was pure politics. But now what the Fed is saying and some of the unemployment reports that came out, now the Fed is actually thinking, I think the New York Fed chair came out and said, it'll be March 1st when we start to do this, lowering rates. The Fed chair, the true Fed chair, Bernanke, came out and said, not so fast. It might be later summer now. So again, they're data dependent, so it depends upon where we are economically. But with this CPI number going higher, it means inflation is still out there. You see it when you go to the store. Mm-hmm. Groceries, we talk about it all the time. Grocery stores are terrible. So again, if inflation rises, the Fed cannot come along and lower interest rates. It will just make that inflationary factor worse.
Yeah. So tell me this. I had heard that there are accounts out there that I can start. I've got a checking account. I pay gas and groceries with
day-to-day living expenses.
I go get a burger. It's my debit card account. It's a checking account. It doesn't make a lot of money.
Yeah.
Is there some sort of money market with the interest rates being what they are? Is there some sort of money market or account that I could put my money into going forward where I can still use it, pull out my debit card and get that burger, but also be making more interest than I would in just a standard checking account?
Yes.
What are those called?
It's just basically a money market is what it really is.
And classically, interest rates were steady. Inflation was low. Money markets weren't.
They were. Back in the day, again, you got to look at it this way. 2008, when the world came to a screeching halt, in 2009 they started dropping interest rates like a rock. We technically went to zero from 2009 up until the last 3 or 4 years where they started to increase interest rates, but it was only because the Fed really had no tools in the toolbox. We were at technically a negative interest rate. You can't publicize that. So the Fed would raise rates slowly behind the scenes, not really say anything, just to give them some ammo, because that's their main tool to fight inflation. If inflation ever shows up, they just start decreasing interest rates or increasing interest rates to see what transpires as it goes. So anytime that they need to spark the economy, they decrease interest rates. Anytime that they need to slow it down, they start skyrocketing interest rates. So since 2008, 2009, we've been zero.
Yeah.
So now all of a sudden, boom, we have the skyrocketing interest rate out there. You can get, 4 point. I think the rolling rate now is anywhere between 4.5, 4.7 in a money market, which, it's to some people is unheard of, but it's been so long. CDs are at 5.
But aren't there certain accounts where I put my money in and it's got to be locked away for 12 months, 18
there's some,
months?
Or you only get 1 or 2 transactions. That's basically the banking side of it, where they want to, because they're taking that money and they're borrowing it or loaning it back out. They don't want you to come back and go, hey, I want my money, or use a debit transaction every other day. But most brokerage accounts have, no limits on transactions, and you get the higher rates.
Does it work? Like I get a separate debit card?
Yeah, separate debit card, nothing fancy.
And it's like, what if I make 50 charges that month?
You got 50 charges that come out.
Interesting.
The calculation, you'll make less interest because you have
less money in
that account as you go.
Well, that's interesting.
Yeah.
So that would be an option that we would want to talk to you about maybe going forward. But there's so many different options out there, and the point being that 10 years ago it wouldn't have made any sense, but now it does.
Today it does. And that's where you see this, I'll call it, for the sake of conversation, a mini run on banks. Not that the banks' balance sheets are bad and they did bad investments or anything like that. The banks have just now started to kind of get competitive with their rates. So 6 months ago, you would go and say, hey, what's your money market rate? And they'd go 2.5%. Brokerage accounts, you're at 4.25. So anybody would go, hey, I can make more money. I'm going to take my money out of my savings account at the bank and go move it over and put it in a brokerage account. And in a sense, most of the regional banks were really having pressure put on them because it wasn't that, a traditional run on a bank where everybody shows up same day and wants their money for fear that the bank is going to fail. It was just people were shifting money over out of the savings accounts back into brokerage accounts. Most of the banks are now, they've realized that, and they become competitive, so they're paying, their fair share, if you want to call it.
Mm-hmm.
So,
well, these are some of the options that you probably didn't know exist, and maybe 5 years from now, they're not going to be
it'll change. It'll change because if the Fed really does start to decrease interest rates, say midsummer, all these money market rates will change instantly. The minute that they do that, it's going to start dropping.
Aside from being annoying to me, having to move my money around constantly, is there a penalty?
No. Most of them are liquid cash, no risk. It's liquid. Kind of the best of both worlds. You got cash and you could do something with it. You don't have to lock it up.
And I can go to my bank and just say, hey, what do you got for me?
Yeah, what do you got? Now, you probably have to ask because we have seen, and I won't name the bank, some of them, if you don't ask, they're going to put you in a savings account and it'll earn 3%. If you go, hey, what else you got? They'll bump you up to their premier money market and you'll get, a point, 2 points, 3 points higher.
Interesting.
So,
all right. So things to keep in mind.
Yeah, and the days of CD shopping are coming back. Back in the day, retirees would go literally take an afternoon and go drive around and look at all the different rates at the banks and pick the best one and go move their money.
And that's back?
And it's back.
And is a CD one of those where you got to lock it up?
CD, you're going to lock it up anywhere between 3 months to 10 years. Mm-hmm. Typically what we've been doing in the past, just because the Fed was messing with interest, they kept raising interest rates, we would do short-term 6 month, and that way you wouldn't your interest rate risk on the backside of that. You do 6 months. Typically, by the time your CD would mature, the rates were higher. You could relock it back in for 6 more months at a higher rate and just keep going on from there.
Yeah.
Now it may play the opposite, which is you may want to do a longer CD because if the Feds then start to decrease interest rates and you're at a 5.5 or 5.45 interest rate today, in midsummer, they start to decrease interest rates. Maybe you do a year and lock in that 5.5, for 12 months or 18 months. So,
yep. So there's so many things that you can do with your money. You just have to know that they exist.
Exactly.
And you have to, many times, have someone walk you through it. We are going to talk about the Secure Act 2.0. It was passed in 2021, but it's starting to kick in 23, 24, 25. So there might be things that we talk to you about, later on in March.
Yes.
I'm going to wait till March.
25.
Or we wait until 25 when we can actually start taking advantage of some of these things. But to know that they're out there is a good thing. Really quickly, bonuses.
Yes.
If you are an employee and you make $100,000 and you get a $30,000 bonus at the end of the year, is that bonus taxed differently than your ordinary income?
As long as it's clocked as a bonus, it's going to be taxed in the upwards of 30% on the federal side. And the reason they do that is, let's say that, and again, you have two camps here. You have the executive side of this corporation and you have the employee side of this corporation. Let's say the executive makes $5 million a year. The employees make $100,000 a year. The problem is if they drop a huge bonus on you, that executive probably owes tax on that bonus at the end of the day because they're in a higher tax bracket. But the employee will overpay their taxes because they're probably not at a 30% bracket, and they'll get a refund back.
Oh, really?
So if you overpay, so your regular paycheck rolling through the year, they deduct your federal, state, and all that fun stuff, and then they pay you a bonus at the end of the year. They're going to up the bonus. You may be, I'll say a 15% withholding rate throughout the year, but it's going to be at 30% on a bonus. You're overpaying your taxes, and if you overpay your taxes, you get it back when you file.
Interesting. So you pay 30% up front. You get your paycheck, and your
and you look at it and you go, and that's where that urban myth comes from. People are like, wait,
my $10,000 bonus is only $7,000.
Poof, because they withheld all that. But if you do your taxes correctly, you're going to get the bulk of it back.
When everything shakes out, you get –
because you're really not at a 30% bracket.
Okay.
Now that executive –
if I'm at 24%, then I'll get 6% back.
Exactly.
Okay.
That's the way to look at it. So, yes, they do it, and IRS kind of enforces this. I mean, you're supposed to. I've seen it where they pay bonuses and they don't withhold anything, and you go, But literally, if you read the regs, the IRS regs, you're supposed to do it at a higher tax bracket.
And when people add in bonuses like this, companies, the $30,000 bonus, someone told me that next year their bonus will be the exact same as their paycheck every year.
That'd be kind of cool.
It's like a double their income, but half of it's bonus. Why don't they just raise my salary? We're going to bonus your salary.
Well, because maybe it's incentive based, one, to make you sell more, to do more, whatever the case may be, and it could be if they doubled your salary. And then the company says, hey, 50% of our sales just went away.
Oh, yeah, they're stuck.
They're stuck, and they're paying these huge salaries, and then they got to lay people off. So I could see where they kind of play both sides of that as they go, to where they say, hey, your salary is $50,000, and if you hit these milestones, we're going to pay you another $50,000 as a bonus. That way, that secondary 50 is always, I call it optional, if you want to say that.
Do commission checks work the same way? With the 30% hit, or that?
If you're a W-2'd employee and you get a commission check, in a sense, it's going to be kicked up at that little bit higher rate, or should be. If you are a subcontractor and your commission check comes in, they just pay you flat out whatever you're.
Oh, you don't pay any taxes on it?
No taxes, so then you have to go back to the estimates.
And pay quarterly.
And pay your quarterlies, exactly.
Okay.
So there's two versions of that.
All right. So if my wife's like, oh, my bonus is going to be taxed higher, I can go back and tell her, well, we're probably going to get a nice kickback.
You'll get the bulk of it back.
Come tax time.
Yes.
All right. And speaking of my wife, every paycheck I get, she runs the show. She pays all the bills and everything. I get a paycheck. We don't have the same bank.
Mm-hmm.
We have separate accounts. I send her, money via Venmo.
Yes.
So that she can move it around and pay the mortgage and pay this, pay that,
yes.
and the other. Am I going to get popped when at the end of the year, Venmo says, hey, you've been paying this person, $30,000?
If they do, it's been kicked. This will be the second year in a row that they've passed. They've kicked the can down the road, just because you get into that scenario where that's not a taxable event. You guys are just pushing money back and forth. If we get to the point where they do kick off what's called the 1099-K, there's ways to work around it to not pay the tax on it.
Right.
And it's completely legit to explain it. It just makes your tax return that much more hairier, in a sense.
Goofy, complicated.
Because now you got 1099-K showing up like you were self-employed, or you were getting an income from somewhere. No different if you guys pass the money back and forth. What if you have a kid in school and you're sending them an allowance, if you want to call it that?
Oh, yeah, via Venmo.
Doing it through Venmo. It's going to look like your child made all this money. In reality, that's you, making sure that they can eat and go drink.
Yeah. Yeah, exactly. But that is one of those things. And my wife was like, why don't you just switch banks and then we can move money to each other through the same bank?
Yes, through the same, yeah.
And I guess I'll have to do that next weekend.
And again, this is the second year that they've kicked that down the road. Because originally it was supposed to issue – they will issue a 1099-K for 200 transactions, or I think it's $100,000 of revenue. If you hit that threshold, they'll kick off a 1099-K. But those are for businesses in a sense. So, that's a ton of transactions going forward. So, yeah.
All right. Well, those are my questions. And without further ado, we'll take a commercial break and come back. Secure Act 2.0. They signed it in 21. But now it's actually starting to kick in, and some of the cool and interesting things that are in there. And, I always say this, they write the tax code for the rich, but sometimes there's stuff in there that actually helps us.
Exactly.
So while there are some probably parts of this that we'll never see or touch or whatever, there's stuff in there that absolutely pertains to us. So we'll get into that and it's something that you can talk to your tax advisor about or your wealth advisor about, or you can just call Jeff and make him both. 636-394-5524. That's Capital Advisory Group's phone number, CapitalAdvisoryGrp.com. If you like what you hear and you have more questions, call Jeff, 636-394-5524. And it's tax season. If you didn't like your tax guy last year, or you hear stuff that we're talking about and your tax guy never brought it up,
yes,
now's the time to switch. 636-394-5524. Keep what's yours with Jeff Zufall, CapitalAdvisoryGrp.com.
Keep What's Yours continues with Josh Gilbert and Jeff Zufall.
Back to the show, back to Keep What's Yours, Jeff Zufall. If you want to contact him, like I said right before we went to commercial break, maybe you didn't like your tax guy last year, or maybe you hear Jeff talking about things that your tax person didn't bring up, or maybe we're about to talk to you about the Secure Act 2.0 and you say, hey, there's a lot of stuff in there that I'd like to take advantage of, and I just don't see my tax person working with me on this, or, seeming as knowledgeable as Jeff is. Jeff can be your tax advisor. 636-394-5524. Open for business.
Yes.
So come on in. Come all. Here's my first question. Secure Act 2.0. Did you read the entire thing?
No. Highlights.
So my question is, when you talk to us about all these new things that are coming out, I mean, you hit – before we started the show today, you said, hey, look at all this stuff in the Secure Act 2.0. And I'm like, Jeff, you got to slow down. We have to start the show. But having the basis of 30-plus years of tax advising, when they come out with a new law like this and you read it, it's just a little tweak to what's already been.
Typically, yes. Sometimes, though, it's a revamp completely. Like all the COVID stuff was like, what?
That's got to be.
But you had to play that game where they put it out there and you had to catch up to it. And then sometimes by the time that you caught up and you thought you understood the rules and how it was applied, the IRS would come back and go, oh, we're going to redo that. We don't like that, and we're going to go this way with it. And so there were many tax laws out there that they put out that you had to basically read up on. And we get, I call them white papers, sent to us galore every time that they do something. And some of them you read it and go, yeah, I get it, boom, you're done. And then others you're like, well, how does that apply? And who could that apply to? So it's just a matter of kind of then adapting it to certain clients.
But with all the knowledge that you've had over the years, when they come out with something like this, you have the basis of how it used to work, and it's pretty easy to transition
in and go, hey, it's just you added this or you subtracted that.
Right. Rather than A, we do B now.
Yeah, exactly.
And you've got all these papers over here. Is this the industry trade magazine?
These are all the stuff, that comes out and it says, here's all the junk you worry about. And this is kind of the white papers.
No
get.
Pictures.
No, there's
words.
No. Believe me, there's no pictures.
Page after page after page, and you've got all these things highlighted on it. So you want a tax guy that reads all the new stuff, and highlights the good stuff. And that's what we're going to do right now. Let's start with emergency withdrawals and the rainy day fund.
Yes. So part of Secure 2.0, which kicks in 24. So part of this kicked in 23. And then the second half, 24, there's 25 provisions, which will be questionable because Trump's tax laws sunset 25, so whoever wins this year's election, I won't say gets to, but will be forced to do some adaptation to it.
And they don't necessarily have to change it.
They don't have to.
They can keep it running.
We default to 2018 tax laws as the issue, and no one will like that.
Right.
Just because of where we were in 2018 versus where we are sitting in 24.
So things could change or things might stay the same, but they have to be – something has to be done.
Yes. And they'll probably be the Keep What's Yours book 2.0.
Oh, great.
After they do this adjustment.
There we go.
But, so emergency withdrawals. So this is something – a lot of people laugh at it. But it's basically saying that the prior to 59.5, any time that you took money out of any, I'll say, retirement account, you paid penalties. Now what they're saying is you can take one distribution up to $1,000 a year, and you'll see how this builds on the other side. And it's basically, it's an exception to the 10% rule.
So I can dip in only $1,000.
$1,000 a year. That's it.
And they call this the emergency. I mean, $1,000 emergency.
It's an emergency
not going to pay my
withdrawal.
medical bills.
No, but a lot of people. I mean, I've read a ton of stats that say most people don't have access to $500 in an emergency.
Wow.
So if you had a 401k IRA and something happened, you could reach in and grab
my fridge breaks.
Exactly, grab $1,000. But then here's how the flip side of this comes into play. Well, you'll see where it'll help you a little bit more. You can now set up within your 401k, if you want to call it, it's an emergency savings account is what it really is. It's a rainy day account. It can be, funded with Roth 401k contributions, but you max out at $2,500. That's it. So once you get $2,500 in this account, it just sits there. It's more than likely, I haven't seen one of these in practical application yet. Mm-hmm. I would assume it's probably some type of fixed interest account where it's not market-based, because if it's your rainy day fund, you don't want to show up and then go, hey, I need $2,500, and you only have $1,000 because the market went berserk on you. So again, that's $2,500. So if you said, hey, I used my emergency withdrawal, $1,000, and now I got access to $2,500, you now have $3,500 that you could get access to.
Now, let me ask you this. My wife is one of these people, and you always ask her every time you see her, you always ask everybody, what can you lay your head on the pillow?
Exactly. Knowing
is in a checking account, a savings account that you have access to.
You could drive,
in the event of emergency.
Drive to the bank, tomorrow morning and go get cash.
What do you need? And my wife's like, I don't know, about $5,000, just in case the AC goes out or something.
Whatever, yeah.
That's sitting in an account right now. Essentially, it's the equivalent of under our mattress.
Yeah.
It is not making any money. It's just sitting there just in case we need to
Mm-hmm.
grab it. With this rainy day account inside of our 401k, with this emergency dip, it's in there, and we have access to it.
Yeah.
But it's making money.
Hypothetically, it's again, like I said, I haven't seen one in practical because this is a month and a half old.
Could be a fixed account.
It's probably got to be a fixed rate or
because you don't want to save money in your emergency fund and then go back in there and
when you really need it and it's not there.
The market tanked and my 2,500 rainy day fund is now 500.
Yeah, and you're like, oh.
So it would probably be more of a fixed account.
Has to be.
You can keep some rainy day money in a spot that is actually making money while it's hanging out there,
sitting there.
But I can go and grab it tomorrow.
If you needed it, it's there. So it'd be $3,500 total. And again, this goes down the path of some of the notices that we've read, from a planning aspect that says, a lot of people couldn't come up with $500 if they had to, without waiting for their next paycheck. Mm-hmm. So again, here's a scenario where you could put money in.
No 10% penalties.
No 10% penalty, and have access to up to $3,500 as a safety net.
But when you go and rob your 401k, even when they allow you to do it without penalty, you have to pay it back.
If it's a loan. But this is a emergency withdrawal from it, so technically you don't have to. But you got 3-year window to pay it back.
So 3 years.
A 3-year window to pay it back.
To pay back $1,000, $3,500.
$1,000, not the $25,000.
Oh, the $25,000.
$25,000 would be an annual ongoing scenario. So if you spent your $25,000, you could replenish it. But the $1,000, basically, you could recontribute it within 3 years.
Can I do $2,500 annually? So next year I bump it up to $5,000.
No, it's just $25,000.
$25,000 flat, and when it's
once
done,
you hit $25,000, it cuts it off, and it's going to push
it
back into the pre-tax side or the Roth 401k.
The emergency $1,000, I pay that back over 3 years.
Yes.
And I can do that out of pocket or
out of pocket. Because typically, if you take a loan for your 401k, only if the only time that you could pay it from an outside source is if you got laid off or fired while you had an outstanding loan. Otherwise, the payback to a 401k has to come back payroll. Mm-hmm. It's the only way to do it. So,
but this I can do it out of pocket.
Yeah, up to 3 years.
Now we know there's an emergency fund out there and a rainy day account out there.
Nobody's buying Maseratis off these. This is just strictly $3,500 total.
And it's much more beneficial than saying, I got $3,500 in a can in my backyard.
Exactly, and earning nothing on it, and it's just pure cash.
With inflation the way it is, it's actually losing money.
It is.
Sitting in that can.
Just nobody's going to send a notice to you going, hey, you had $3,500. It's now worth $3,200 because of inflation.
Now, I've got a Roth, and I've got a 401k, a traditional 401k.
Yes.
I've got
pre-tax and
after tax, and you always talk to us about buckets.
Yes.
I've got a little money in a brokerage account, but I've got both a Roth and a 401k. What is this new Roth 401k payouts?
So basically what it's saying is it's going to take the tax benefits of a Roth IRA, and the contributions are made with after-tax dollars. And then when they originally did this, they said that if you had a Roth 401k and a pre-tax, and you took dollars out of your pre-tax side for whatever reason, it would force prorate the exact same amount back out of your Roth 401k. They're now segregating those two. They're two totally different transactions. And if you were subject to required minimum distribution, there is a weird provision out there that the IRS said, hey, you have to take a RMD from your Roth, and you go, well, it's after-tax money. Why would I ever have to do that?
Yeah.
But they fell in the same category, and it was not by design. It was just by the way they wrote the rule, in a sense. So they've adjusted it, and clarified it, and it's actually two separate transactions, if you want to look at it that way.
Now, this is where things get difficult for the layman or the layperson, like myself.
Yes.
Where I can obviously see the benefits of having the rainy day account and the 401k emergency exception of $1,000. I can see the obvious benefits there. Does this Roth payout thing, does this help us?
Yeah, because the Roth 401k, remember, is after-tax dollars, and you have access to it at your contributions come out tax-free. You just can't take any earnings out of that account. It's 5 years, 59.5, whatever's longer. So if you put $1,000 in your Roth 401k, you can go pull it out. What I think is going to take place is it's going to be the taxable reporting side of it. If you take money from a Roth 401k, it's still going to kick off at 1099. It's going to have a little box check that said taxable amount not determined. Yeah. And then on the tax return level is where you go, hey, I put X into a Roth, and it does this calculation for you. Whereas these emergency withdrawals and the rainy day fund, I don't think it's going to kick off any, I would say, taxable reporting. But again, wait and see what transpires.
Yeah, and as we mentioned last time, it's not a taxable event to you, but the IRS still wants you to
know
log
about it. So there
there
might be some type of, on a 1099 distribution, some weird code that it gets, and
got to mention it.
Not that it's a rainy day fund, but it gets a code something that's tied to it.
So this would be something where, and just putting this back on a normal person like myself, this would be something where I would come to you and say, "What's new in the law?
Yeah,
here's my stuff. You know me on paper. You know what I got going on. Does any of this stuff help me?"
Yes,
and
then we say
you could start
this piece
doing
and
it.
that piece apply to you, and it would help you. The rest isn't going to do a thing for you.
How about this? How about that? I mean, I see you not every quarter, but twice a year, tax time, and then over the summer we do a little meet and greet and just make sure that we're on the path as we head into the end of the year. How about this? This tax code stuff, way beyond all of us. But could I call you on a random day? Could I, maybe get an appointment and just say, Jeff, we're thinking about doing this with our money.
Yes.
Not like every time I go to the store to buy a loaf of bread, but hey, we want to do a boat. We want to get this.
Exactly.
We want to do a new car. We want to do that. What is in the tax code that helps us or hurts us in our situation when it comes to this big purchase?
That's what we do all day.
All day? So I can call you and
Literally,
say...
people typically, it's like, hey, here's what I got to do, college, whatever the case may be, what's the best way to do it? And it sounds goofy, but it might be a series of little steps that you take that save you $500 at the end of the day. You got to write a check for it anyway, but you save $500 to get there.
Hey, that fireplace project that we just did, how do I do that in the most tax beneficial way, the most financially sound way? Do I take a HELOC? Do I borrow money from my house? Do I borrow money from 401k, rainy day fund, whatever?
Make all your neighbors that come over and sit on a cold night pay you $5, and then
you're it'll pay for itself. So if there's a big home project, go talk to Jeff.
There's ways around it, because again, one of the things is mortgage interest. And again, this has nothing to do with the Secure Act, but this is part of the tax code. The mortgage interest. So let's say that you go and take a line of credit, HELOC, from your home, and half goes to buy a new car, but half goes to that fireplace project. From a tax person's angle, I can't take all the interest that you take because you didn't use it to improve or expand upon your existing property. So what we have to do is then say, ooh, what'd you spend that money for? And a lot of people are like, well, who cares? We need to know that. So the concept is, let's say it's a 50-50 split. I have to take 50% of that interest that you get on that HELOC going forward forever until it's paid off, and you only get to write off 50% of it as you go.
So I do 25. Let's just say I took $25,000 on my HELOC. I did the fireplace. We replaced the HVAC, and then with the last $5,000, we paid off the car.
Exactly.
I can't deduct the car.
Exactly. Everything else
the
can.
Home improvements, I can't.
Home improvements do. So it gets tricky.
See, and everybody's got a project coming up because it's spring, it's summer.
Exactly.
Everybody wants to do a project.
Other than the interest rates have skyrocketed, so that will put some dampers on borrowing money.
Right.
So,
but you can do the math on that stuff for us, too, and just say, look, this is how much it's really going to cost you.
And it would save you this, or, hey, it's not worth it because you can't itemize, so don't worry about it, but you can't write it off anyway.
So. And Jeff will look at the numbers and say, boy, you should have done this 4 years ago. 636-394-5524. You got a big purchase coming up. You want to take some money out of your house. You want to do some home improvements. You want to pay off the car. You want to do this. You want to do that. Jeff can walk you through and say this is the most tax beneficial way of doing it. And not to mention the fact that he's a wealth advisor as well. Yes. He can say these are the accounts that you want to take it from. And these are the accounts you don't.
You don't touch them. Let them go.
Don't. And with this new rainy day fund and this new emergency withdrawals, I got to imagine a fridge going out or an HVAC system going out. That would be there. Yeah. And you can do that in a tax beneficial way where you don't have to pay a 10% penalty, robbing from your 401k. 636-394-5524. A lot of this stuff is new. And a lot of this stuff is just advancements on what was already
older rules that they've helped along the way.
Yeah. So even if you think that you know the tax code, you don't know anything, okay? Because it's changing all the time, so you need somebody like Jeff to help you out. CapitalAdvisoryGrp.com. Let's go to our last break, and then when we come back, a couple more things to know. Employers can help us out with our student loan repayments, and you got a 529 for your kids' schooling, and they got a free ride? Yep. What am I going to do with all that money I socked away? Well, there's places to put it. We'll talk about that and much more. It is Keep What's Yours with Jeff Zufall.
Keep What's Yours continues with Josh Gilbert and Jeff Zufall.
Back on the show, Keep What's Yours. And, Jeff, you got the book out, Keep What's Yours. It's a handy-dandy book. It's partialed out with a bunch of different chapters. Some chapters pertain to us. Some chapters pertain to small businesses.
Yes.
You specialize in small business.
Yes.
So if you've got a small business out there and you don't understand how you make a lot of money, but you're not making any money.
Exactly.
Jeff can do an audit and take a look and see where you're bleeding money and where you're bump up the pluses and minus the negatives.
Exactly.
So that's kind of how Jeff can help you with your small business and make sure that the money coming in stays in and doesn't get washed away with just stupid moves.
Yes.
We say all the time, I know flowers, so I open up a flower shop. You know what I don't know? books,
exactly.
taxes,
how to keep the books in order, and what a profit loss looks like, a balance sheet. Those are primary.
I never had to do math when making a flower arrangement, but all of a sudden, as a business owner, now that's all I'm doing. So Jeff can help you out in that way. But with the Secure Act 2.0, there might just be a new Keep What's Yours revision.
More than likely, there will be.
And then with the new tax rules that are probably coming down in 2025, maybe it'll be version 3.
Yes.
Maybe it'll be a whole revamp.
Might be a whole revamp, probably.
Keep more of what's yours.
Yeah, exactly.
With Jeff Zufall. So Jeff can get you a copy of the book, 636-394-5524. If you like what you hear, you're not getting this information from your own tax guy. Maybe your tax guy did your taxes last year, and you don't think your refund was as big as it should have been. Let Jeff take a look at it and have a crack at it. Capital Advisory Group. All right, rollover 529. You've been saving money for your kids' college, but guess what? They joined the military. Congratulations. Thank you for your service to all of you out there who have made that decision. But you don't need any money because the one good thing that the U.S. does to our veterans
Flip the bill.
is they give us the GI Bill and they pay for schooling. So what am I going to do with all that money I saved for all those years for college?
Exactly. In the past, that was always everybody's issue with the 529. They're like, well, what if? Well, today it's fixed. And I'll say, well, I shouldn't say it's fixed. It'd be easy if you just say, hey, take the money out and run, but you can't. So you can take out and convert from your 529 to a Roth IRA for the beneficiary, which is technically the child. And you'd be able to do what their annual contribution rate is. So say it's $7,000 a year, every year, up to $35,000 lifetime. And once you hit that cap, again, brand new provisions, we're assuming that once you hit that lifetime cap of $35,000, that you could change beneficiaries. But we will see. That's to be determined in the future.
So the 529, the saving for a college plan, you explained this to me a couple of weeks ago. It's kind of like a Roth. It's after-tax money that you put in.
Yes.
It grows like a Roth.
Tax deferred, which means you don't pay any current income tax, no capital gains.
Everything you gain
dividends
off of it is yours. You don't have to pay taxes on it or capital gains on it. But you can take it out 59 and a half or 5 years. That's the rule in the Roth. But you can take it out whenever you want as long as it's for school.
School or higher education, computers, tuition, tutors. That's something in the past that was never in there.
How closely does the IRS watch that?
Well, you got to have the receipts. So the concept is always act like they're looking over your shoulder. Mm-hmm. And again, you have to have the receipts to be able to go, hey, I could prove this if they ever knocked on my door and said, hey, you said you paid a tutor $300, did you? And you go, hey, look, here's my receipt for $300 for a tutor. You're safe.
So instead of just, like I said, keeping money in a can for college, keeping money in a savings account for college, you can put it in this. It can grow exponentially.
Yes.
And you won't ever have to pay taxes on it if you use it correctly.
Mm-hmm.
So it is kind of like a Roth for school. But if you don't have to use it for school because your kid got a scholarship or they're serving our country, you can convert it to an actual Roth.
Yes.
In the child's name.
Yes. We've already done.
Let it keep growing that way.
A dozen of these for the people who said, hey, my child may go get a PhD, MBA, whatever the case may be. And then turns out they change their mind. They got a job. They're like, hey, I'm good. I'm done with school. And this money's sitting in there. In some cases, it's 6 digits.
So but the limitations are that it needs to be used for school. But the bonus is everything that accrues and grows in that account over the next 17 years.
Exactly.
Is tax-free.
Is tax-free as long as it's used for those items.
And then if you don't use it for school or there's money left over because you started saving and the market went jackpot.
Exactly.
Your kid only needed $50,000 for school. You can convert it to a Roth for them and start there.
The only caveat is the 529 plan had to be open for 15 years.
Okay.
So if you started when your child was younger, go back and look at it and say, hey, just sit on it. If you got 2 years to go, wait 2 years and then start doing these Roth conversions.
Sure.
Non-taxable. So it's beautiful.
And these are ideas that we don't know exist.
Yeah.
So we can have Jeff walk us through them and get us set up. And, halfway through the process, you check back 6 years later and you say, man, look at how much money's in there.
Exactly.
Maybe we don't need to be contributing this much.
Yes.
But the way that college is these days,
usually
you're probably not putting enough.
Exactly. You're short because college is going at 20% tuition hikes on an annual basis.
Yeah.
And, market can't keep up with that. So.
Well, and then all my harebrained schemes that I have is like, well, maybe I'll put in by the time my son goes to college, I'll be 59 and a half at
That's
least.
Right.
Maybe I should just double up on my Roth, and and Jeff will have to say, settle down, Josh. You're not as smart as you think you are, and legally speaking, we have to keep ourselves honest, and Jeff will help us with that as well. Thank you so much for walking us through the Secure Act 2.0.
You betcha. Thank you.
And as things come down the pipe, things might change, and so we'll address those on next week's show.
Exactly.
That's what we're here for, to tell you that these things exist, and hopefully you give Jeff a call to put them in action in your own set of finances. 636-394-5524, 636-394-5524, or CapitalAdvisoryGrp.com. Jeff, thank you so much.
Thank you.
You've been listening to Keep What's Yours with Josh Gilbert and Jeff Zufall, Senior Tax Strategist and Wealth Manager at Capital Advisory Group. To learn more, call 636-394-5524 or visit CapitalAdvisoryGrp.com. The views and opinions expressed in the preceding paid program are those of the host, callers, and guests, and do not necessarily reflect the views or positions of this station, its management, or owners.